Hey, what's up, everybody? Chris over here, founder of PollinAteTrading.com, and I'm going over the overnight anomaly or the overnight gap trade again. Yesterday on the channel, I dropped a video covering it. It's something we're trading live every day in the trading lab right now, and I'm going to show you where we had another gap yesterday. We got another gap today. Got another one. We're in a good environment for it. So I wanted to give you a little bit more understanding of it. So let me share my screen. First thing I want to point out, yes, I am using TradingView for this to show you. I use TradingView because that's my charting package. I built this out in Python using 1 minute data on the S&P 500 futures E-mini ES contract with data back to 1997. That was the original way that I tested it. So in Python, created the strategy, and all I wanted to do was validate that it worked, that there was an edge there, that if I did this over the course of hundreds and thousands of trades, it would have a slight edge, and it did. And so that backed up all the research that I had done and read. So that's kind of where this whole process starts. I read these academic papers on algorithmic trading or different edges in the market, and then you just go and try to recreate them, see if you can get some sort of edge, validate the edge there. And then once I have that, then I start dialing it in. So the basic strategy is just buy on close, sell on open of the S&P 500. Now, obviously, you're going to get long periods of that not working, and then, of course, periods of it working. So kind of it comes in these different segments. And what we do here at Pollinate, we're very focused on identifying the different type of market regimes that we're in. So we're in trending up, trending down, sideways. We're in a nice quiet trend, or are we in a high volatile type environment? And each one of those generates some score. Some of it, let's say gives you a Sharpe ratio, or gives you, one environment for this strategy is going to be way better than others. So if that turns out being, 100 days out of every 500, it's not like it's fine. You can add it to a portfolio of strategies. You just need to make sure that it doesn't work around the 400 other days when it's not in that regime, right? But luckily in this one, it works quite a bit, especially on the S&P 500, because the S&P 500 tends to gap up overnight. A lot of its moves happen in the overnight, and gives you a nice little edge. One other thing that another thing that we did is we started looking at, okay, towards the end of the trading day, are there indications that something might be up? Like there might be a reason for, like, think about this. If you were able to look into all the transactions on S&P 500 futures or SPY or whatever, and develop patterns, identify and identify patterns that said, hey, it looks like somebody's buying this up. And then, later that week, or the next day, it looks like somebody's selling it. Or let's say somebody's buying this up and, oh, look, we have a gap up overnight, something, like there's some sort of price action, something happening in the price action that would indicate that. And so one of the things that we can do, let's just throw something like volume here. So if we throw the volume chart, sure, you can see that this was yesterday, Wednesday, today's Thursday. You can see that as we started, and now what I do is I set a window, a period that, we're going to monitor. Do okay. Yeah. So let's say it's from let's just go where did this bottom 23 12:30. Let's say 12:30 to 1300 or sorry, 3:30 to 4 p.m. Eastern time. Okay. So what I'm going to be looking at is better. Let's move down here. Here. So I want something in here. This is just an example. This isn't okay. This is an example of something I would do. I would go in and I would say, okay, what's indicative in here of the potential for a gap the following day. The first thing I would say is that notice that the entry was here after 21 minutes or so. Notice that it happened after this spike, after this volume spike. So this is my window here. My window, actually, let's bring this back up. And again, let's do it. And then, so what I see is I see this little spike here, right, in volume. Now, you're going to get that every day, right? You're going to get more volume kicking up in here. But what I'm looking at is I want to see volume to like really start to increase there. Now, here's some like inside baseball, whatever terms. As a software or algorithmic trader, oftentimes you write code that says something like, if this condition and this condition and that condition and all this other stuff happens, then sell or buy the next bar, limit, stop, market, whatever. Like it in essence, you're saying like when 1, 2, 3, 4, 5, 6 conditions are met or whatever they are, then do something on the next bar. So you'll notice that the last 10 minutes is when all this happens, right? So what you see is software developers will start to, or algorithmic traders will start to either buy to close, right? If they're short on the day, they'll cover their positions here towards the end of the day, or sell their positions towards the end of the trade day. Why is that? Why would you trade? Why would you do that at the end of the day? Well, you can see volume completely dries up right here, and it's almost dead volume overnight. It's just a handful of folks trading with each other overnight, and also overnight margin requirements are calculated after the futures trading close. So at this point right here, so 6:15, 4:15 p.m. Eastern time, New York time, that's when your broker calculates what positions you have on and the margin you have available. So you can have, let's say for like a S&P 500 micro contract, it might be $2,000 to have one contract. And intraday, and then it might be like, actually it should be smaller than that, but then overnight might be like $10,000 or $12,000. So a lot of traders will do all their day trading, and then towards the end of the day, they'll close out. Okay. So that causes this artificial spike in volume towards the end. So, you don't want to hold a lot of people also don't want to hold risk overnight because, well, we sleep. We can't monitor the news. And also, if we can't monitor the news, other people can't monitor the news. But what if we are monitoring the news? Well, other people are not monitoring the news. So it's this overnight period, which is this gap period, that news can come in. Overnight traders. So here in the United States, we're likely asleep. Europe gets the news. They wake up. The Middle East, Africa, Asia, Australia, they're on like kind of like the opposite time zones of us, at least a third to 50 to 100%. No, whatever. When it's like right now, in New York, it's almost 5 p.m. In London, it's 10 p.m. Mumbai, it's like 2:30 a.m. Sydney, it's 7 a.m. Tokyo, 6 a.m. 5 a.m. Beijing, 12 o'clock in Riyadh. So there's all these different people in different time zones. So if news comes out, like tonight, for example, the core CPI for Japan, I believe, is coming out. Japan's been a big issue lately. So there might be some sort of gap action that happens up or down, because that's a big number. And right now, in this period of time, today that we're speaking, the Japanese yen has really, there's been this, we're a couple weeks out from a yen carry trade unwind. And so what we've seen is these overnight moves have been a lot more active. And so I'm looking for things. And by the way, I'm just giving examples of what I'm actually looking at here. There's a couple of other things in context, but this is the sort of stuff that I would say, okay, I've read my research paper. Okay, so read research papers on overnight anomaly or gap. Jeez. Okay, that's one. My microphone's in front of my keyboard. I'm trying to do it. Okay, two. Okay, find a paper to replicate. Replicate the confirm results are same as the study paper, right? So in essence, what I'm going to do is I'm going to go to like Google Scholar or like quant research. I'm going to go find it, and then I'm going to go try to replicate it. If I replicate it and discover that there is an edge there, I'm going to say, okay, cool. So confirm there is an edge. Okay, so the first thing I'm gonna do is confirm that there is an edge, and then I'm gonna go and attempt to see if I could just, implement that with the edge and see if it's profitable or not. And then, of course, you have to add in some other factors like slippage and commissions. Add in real world things like, okay, yes, it works great here. It can handle this trade, but it can only handle like 20 contracts. It can't handle, if 21 contracts are traded at that point in time, it blows up the edge. Like there's a lot of ways that it could be not useful, right? So just go and confirm the edge. And then I'm going to, okay, now I'm going to try to identify other context to like regimes. So for me, what I'm trying to find is like, okay, does it work in a bullish and a bearish regime? So for example, in 2022, that was a bearish regime. 2021 was a bullish regime. 2020, half the year was extremely bullish. Half the year was extremely volatile, kind of sideways. So I want to like find these different areas and determine where the strategy works best. If it works in all of them, goodness, well, you're lucky. If it has periods of underperformance and just sideways churn, it's kind of great. If it has periods that just go straight down, that could say, okay, cool, we can just do the opposite here almost. So there's a number of ways to do it. Now, when we talk about regimes, if we're talking about like really micro regimes, then a micro regime could be the last 10 to 30 minutes of the trading day, right? That one is actually an important regime, the open and the close. But what I'm looking for is actually much larger regimes. So like the last 22 trading days, which is a month, or last 66 trading days, or 108, maybe something like that, the last 6 months or the last year, and just kind of identify where we are. Sometimes you have to use multiples, or sometimes you use smaller times or larger times. But the idea is you want to understand what is it generally like. And the way I want to organize it in your mind is a regime is like a season, especially these big regimes, a season of weather, where that if it's June in North America, not all the way up into Canada, part of North America where it's scary and cold all the time. But let's say in June or July, you're probably going to have pretty nice weather. Like you're not going to have to worry so much about the snow. You're not going to have to worry about you're going to have to worry about heat and excess sunlight more than you are worrying about snow and things like that. Whereas in, let's say, January or February, and in that part, there's going to be low sunlight and colder temperatures. So yeah, you may have a warm day in the middle of January, but it's not going to be, the hottest day of the summer type temperature. And certainly the sun's going to be going down a lot earlier. That's very similar to what a regime is. It's kind of this bigger picture thing. Each individual day could have its own outcome, but over the course of months, it'll look very similar. And so that's what I try to do is like, okay, where is this going to be within a good regime and where is it not? So identify other contexts like regimes is a good example. The next thing is something that gives me a clue that maybe price is going down, but let's say a VWAP is, volume weighted average price is higher, or, something gives you a thing that like, hey, this is, even though the price is down, it's been up until this, up until like, it's been a good day all the way up until here. And then it went down, but that's kind of odd. So let's not pay attention to all this. Let's just pay attention to this. We want to see how it closes because that'll give us a clue on how it opens. That's ultimately what we did on this one. Okay, so we start to see, let's say, that average volume spike. Boom. Okay, that says, hey, guess what? We're probably going to get some action tomorrow. We have a few other, like I said, regime, a few other things that gives us a clue that it's going to happen. And then the signal fires out. Now, the reason I have it in TradingView is because I have the code that I used in Python and that I use in Multicharts. Multicharts is a trading platform that uses you can code your algorithms in to trade for. You can use indicators, whatever else you want on it too, but it's also algorithmic trading platform is how I use it. And so I decided to go code it over there and in TradeStation. So it's kind of like these multiple verifications. I used this raw data from the S&P 500 in Python. Then I took it over to Multicharts and then confirmed it in TradingView or TradeStation. I'm like, okay, cool. I feel comfortable putting it in TradingView now. And the reason I can say that is because I go and I put I write the same code in TradingView that is done in Multicharts and Python and everything. And as long as it fires, the syntax is different for all of these, but the way it works is all generally the same. And as long as the trades fire the same on TradingView, TradeStation, Multicharts, and Python, as long as it's the same trade, then, or within a bar or two, sometimes there's some way that a software, like one of these softwares, may read, or even a data set might be different than one another somehow. There might be some sort of anomalies, but what I'll do is I'll go output all the trades and then I'll compare them. We'll go to strategy tester and list of trades, and I'll just go and compare all the trades that they're the same entry and exit time and whatnot. And so that's what we got with that. Now, the downside of having it in TradingView is it only, because I'm using 1 minute data, TradingView is only going to give me 26 trades back or whatever. It's only going to go back to, where's the first trade? June, I think. Yeah, back to June. We're currently in August. So 2 months or so worth of trading data because I have the continuous contract going. Now, if I wanted to, I could go and get 1 minute data on everything. I would just have to change this from continuous contract to like ESH 2024, ESM 2024, blah, 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 so that it would get all of them all the way through. But since I had so much data already, as long as the last 20 whatever trades worked, it was fine with me because I really have the robust data, which is you see in the trading lab. We share that stuff with in the lab, you can see. And so in essence, we have the condition is met here. We go on the next trade, and this one happened yesterday. So I bought. Now, let me throw this out here. Strategy tester. Okay. Performance summary overview. Here's okay. So let's do average winning trade 1,282. So it's one S&P 500 big contract. An average loser trade is $735. Now it doesn't really show us the drawdown, overnight drawdown. So it's not going to say, like, if I get long at 56.37.75 and this thing goes down to 56.500, and then by the time the opening bell kicks off, I'm already back 56, so I have like a 200-point drawdown and a 30-point profit. That's one issue you're going to have with this overnight trades. And so what I like to do, the way I like to trade this, is I go and buy cheap calls out of the money one day. So yesterday was the 21st. So I bought August 22. So the next day, one day till expiration, calls. They were 15 deltas. So I went deep out of the money. They cost me $26 per contract. Okay, so there's 26 cents. They're priced in cents, but you're actually paying dollars. And so I sold that at, I believe, 92 cents. So that was like a 250% gain. So think about it. Let's say you bought 10 contracts. That's $260 you paid. And then you sold it for 900 and something, 920, I think. So what is that? Like a $650, $700 profit. Now, if you were to buy it, if you were to go and buy futures, even with the micros, first of all, you have the overnight margin to deal with. So it's going to be a lot more expensive. And then next, it's going to, like I said, this thing could go against you 200 points overnight, but still you could end up in the morning up 30 points, right? So by using the options, that at least gives me, and this is me, not you, that gives me the security to know that if the world, something crazy happened overnight, because we are literally trading the last part of the day and the first part of the day. So stuff can happen. Like, where is the most volatile place in the world right now? It's the Middle East, right? And that happens, and Europe, I guess. That happens while we're asleep here in North America or in the Americas. So a lot of stuff can actually happen and have a big effect. And, the Japan. So tonight, Japan's going to happen. We'll be probably, winding down, get ready to go to bed here if we're not already asleep when that thing hits. So, at least with the options, my loss, if I bought 10 contracts, my guaranteed loss on that is $26. And you know what? The night before, I think, did we have one the day before? We did. The day before, my options were basically flat, even though, this thing went from 56.21 to signal 56. So a 10-point move, I basically made nothing with the options. This one was a 37 to, so a 25-point move or so. And I, 2.5x to my money. So you still have to deal with the volatility, the implied volatility, and all that other stuff that happens. That's another part of options that kind of makes it challenging. Okay. Now for today, I had another trade. Now, again, look at our window, right? You can see that the volume kind of stays low, and then, oops, here's this guy, this spike in volume, this change. You see it ramping up. Okay. And it ramped up in our window. The volume ramped up in our window, knowing that people are going to be closing out. Who's going to be closing out? How are they going to be closing out? In this regime, the likelihood that we're going to gap higher is way over 50% if we gap. If we gap, the likelihood that we're going to gap higher is over 50%. So we got the opportunity to buy these calls. I bought 562 calls on S&P for 43 cents. So, 10 contracts is $430. That's almost twice as much. So you're looking at like 5 or 6 contracts if you're looking at that same $250 worth of risk, right? And then who knows? We may gap down and then it's zero. It may gap down to 555 or who knows, like way out of the money, and we're just like, oh well. In that case, if it's basically worthless, I'll just sit on the calls and see if they come back, because they've already hit the worthless point. And so at that point in time, I'm just trying to do it. So that's how it works. Let me show you again. This is this thing has just been incredibly good for the last 2 months. I think it's my win rate here. 76. Yeah, 76. So 20 wins, 6 losses. And there's currently another open trade. It's a great system. It's a lot of fun. There's a couple of people I know that are running this in the lab. That's all they do. They have other positions on, but the only active trading they do is this system. We've been testing it out with a handful of people. It's something that I've been working on over the years too. And, the only real way you can get it is in the trading lab or build it yourself. But we generate live signals. So the last part of the day, last little bit of the day, like, hey, we're warming up for a trade, and trade pops in. Once the alert hits, we buy our options or your call or your, however you want to do it, the stock or whatever, and then go about our evening. Tomorrow morning, wake up, wait for the signal to come back and say, hey, exit. And when it does, boom, we exit. You'll notice that we pretty much caught it right before it started to move up in the end of the day, and then right before it broke down. As soon as it broke down, right before it broke down, we were out. And, we could have lost money on that if we just held it for the next day. But yeah, so pretty good little system. We're introducing, we have a couple others in the lab. So if you want to check it out, come check it out. This is a little bit deeper explanation of how I built it and how I like to trade it. Mostly because a lot of lab members have asked about it. And I was like, well, why not tell everybody? So if you're a lab member, feel free to ask me more about this if you want. If you want to trade this with us, join us in the trading lab. We have other swing trading systems. I got a crypto system coming out, swing trading system coming out. I got a futures day trading system coming out. And then, of course, we have a couple of equity swing beast and a momentum system, and also a futures swing trading system coming out. So if you'd like, join us there. Love you all. Bye.